While the rest of Europe is begging for affordable housing, Germany is quietly giving it away. Right now, in 2026, German home prices are cracking. Not everywhere, not dramatically, but in specific cities, the numbers are moving in a direction that hasn't been seen in years. Downward. And the cities falling hardest are not random. There's a pattern buried in the data, revealing deep fault lines in Germany's economy, its demographics, and its industrial identity. Some of these cities are bargains, some of them are traps. Let's find out which is which. Number 10. Dessau-Roßlau, Saxony-Anhalt. We start at number 10, and already this one is haunting. Dessau-Roßlau sits in the eastern state of Saxony-Anhalt, and unlike every other city on this list, the decline here isn't just a 2026 story. Long-term projection models flag it as one of Germany's biggest real estate losers through 2035. Roughly 1% in real annual decline, compounding year after year. The reasons come down to three things: population loss, economic weakness, and illiquidity. Young people left for Berlin and Munich decades ago. There are no major employers, no university, no anchor pulling people back in. And when you do buy here, getting out is the real problem. Yes, prices are extraordinarily low, and for buyers with a 10-year horizon and a high risk tolerance, there's a contrarian case to be made. But for most people, Dessau-Roßlau isn't a bargain. It's a lesson in what happens when a city runs out of reasons for people to stay. Number 9. Wolfsburg, Lower Saxony. At number 9, we move to a city whose identity is almost entirely built around one company. Wolfsburg, home of Volkswagen. When VW does well, Wolfsburg thrives. When VW struggles, and right now VW is struggling, the city feels it in ways that go far beyond factory floors. Asking prices are down roughly 0.2% year over year, sitting at around 2,524 euros per square meter. That sounds modest, but pair it with the broader picture, and the risks compound quickly. The global automotive industry is in the middle of a brutal transition. Electric vehicle competition from China has put enormous pressure on European manufacturers. VW has announced layoffs, restructuring, and cost-cutting at a scale that would have been unthinkable 5 years ago. And Wolfsburg, a city of around 125,000 people, has no real backup plan if the automotive engine cools further. Add an aging population to the mix, and the demand outlook gets murkier. For buyers, the entry price is reasonable, but the thesis here depends entirely on believing that Volkswagen will navigate this transition successfully and keep Wolfsburg employed. That's a bet, not a guarantee. Number 8. Gütersloh, North Rhine-Westphalia. Number 8 brings us to Gütersloh, a smaller city in North Rhine-Westphalia with around 100,000 residents and a manufacturing-dependent economy. Prices have slipped about 0.4%, settling near 2,737 euros per square meter. The profile is familiar. Limited buyer pool, regional economic softness, and not enough population growth to offset selling pressure. Gütersloh isn't dramatic. It's not collapsing, but it sits in a category of mid-sized German cities where demand is simply not keeping pace with supply, and where structural headwinds make a strong rebound unlikely in the near term. Number 7. Bielefeld, North Rhine-Westphalia. Number 7 is one of Germany's most mocked cities. And yes, we're going there. Bielefeld. The subject of a long-running German conspiracy joke suggesting the city doesn't actually exist. It exists, and its housing market is softening. Prices are down about 0.4% to around 2,783 euros per square meter. Bielefeld is actually one of the more interesting cities on this list because it has real assets: a university, a decent industrial base, relatively strong infrastructure, but moderate demographic risks and the broader NRW pattern of weaker demand are putting downward pressure on asking prices. For buyers, Bielefeld has more upside than most cities lower on this list. There's a genuine local economy here. The decline feels more like a correction than a structural unraveling. If you're looking for a mid-sized German city with genuine habitability, strong local services, and a softening market, Bielefeld deserves a closer look. Number 6. Moers, North Rhine-Westphalia. Adjacent to the broader Ruhr region, this city carries the industrial legacy of a Germany that no longer exists in the same form. Coal, steel, manufacturing, all of it contracting over decades. Prices are off about 0.6% to around €2,382 per square meter. The story here mirrors Krefeld, which we'll get to in a moment, and fits a broader pattern of Ruhr-adjacent cities where economic softness and demographic pressure combine to dampen demand. What makes Moers worth mentioning specifically? For cash buyers targeting rental income from essential workers, the price-to-rent ratio can actually work. But you need local knowledge, patience, and realistic expectations about resale. Number 5. Krefeld, North Rhine-Westphalia. Number 5. Krefeld. Once a city famous for silk and textile production, Krefeld has spent decades navigating the decline of those industries without finding an equally powerful replacement. Population challenges persist. The buyer pool is thin. Prices are down 0.6%, hovering around €2,443 per square meter. The textile legacy left Krefeld with beautiful old buildings and a distinct architectural character, but not enough economic momentum to translate that heritage into strong property demand. This is a city where the gap between history and economic reality is wide. For renovation investors who love a project and understand local dynamics, there are deals here. But this is absolutely not a passive investment city. You earn your returns through hands-on value creation, or you don't earn them at all. Number 4. Stuttgart, Baden-Württemberg. And here is where this list gets genuinely surprising. Stuttgart, number 4. This is not supposed to be on a list like this. Stuttgart is one of Germany's economic powerhouses, home to Mercedes-Benz and Porsche, a hub of engineering excellence, Baden-Württemberg's crown jewel. And yet, asking prices have pulled back roughly 0.8% to around €4,395 per square meter. So what's happening? The answer likely isn't structural collapse. This looks more like a post-boom correction in a city where prices ran very hot for a long time. Buyers grew cautious. High interest rates made monthly payments painful at these price levels, and affordability stretched to a point where demand slowed. Premium segments have softened. Transaction volumes have dipped. But here's the key context. Stuttgart's fundamentals are strong. Employment is high. In-migration continues. The city has real economic anchors that aren't going anywhere. The decline may be temporary. It may already be reversing. Which means for buyers who have been waiting for an entry point in Stuttgart, this window may not stay open long. Strong foundations with short-term softness. That's a very different opportunity than what you'll find in the cities lower on this list. Number 3. Berlin. The third biggest decline on this list is also the most counterintuitive. Berlin, Germany's capital, Europe's coolest city, one of the most in-demand rental markets on the continent. Prices are down approximately 1% in certain segments, sitting around €4,819 per square meter. And the reasons are layered in ways that take a moment to unpack. First, regulation. Berlin has some of the most aggressive rent control policies in Germany. That creates a strange dynamic where rents are capped, investor returns are compressed, and institutional buyers, who would normally support prices, pull back. Second, oversupply in specific districts. Parts of Berlin saw significant new development in recent years. In some submarkets, supply has genuinely caught up with demand in ways that put downward pressure on offering prices. Third, a post-boom correction. Berlin was one of Europe's hottest real estate markets for most of the past decade. A cooling was almost mathematically inevitable. But here's what makes Berlin different from every other city on this list. The long-term demand story is not in question. Population is growing, the startup ecosystem is expanding, international migration continues. The decline in Berlin is a market phenomenon, not a demographic or economic collapse. Selective buyers who can identify emerging neighborhoods, who understand the regulatory landscape, and who have a longer time horizon could find genuine opportunity here. Core Berlin remains a different asset class from everything else on this list. Number 2. Siegen, North Rhine-Westphalia. We're in the final stretch now. Number 2. Siegen. A mid-sized city in the southeastern corner of North Rhine-Westphalia, Siegen has a university and a manufacturing base, but faces real headwinds from slowing industrial activity and demographic outmigration. Prices are down 1.6% to around 2,295 euros per square meter. That's the second largest decline among major German cities with current data. The buyer angle here is straightforward. If you're a renovator, a cash buyer, or someone comfortable with a longer hold, Siegen's price level offers a genuine entry point. The university provides some demand for rental properties, but further pressure from regional outmigration is a real risk, and one that current data suggests hasn't fully played out yet. The honest assessment? Siegen requires a very specific thesis to work. Without one, it's easy to buy in and watch prices continue sliding. Number 1. Salzgitter, Lower Saxony. And at the top of this list, with the steepest year-over-year decline among major German cities in 2026, is Salzgitter, a former industrial and steel town in Lower Saxony. Population around 100,000. Price per square meter approximately 1,637 euros. Let that number sink in. In a country where Munich averages above 9,000 euros per square meter, Salzgitter is at 1,637 euros. That is not a typo. That is genuinely one of the lowest entry prices for a German city of this size anywhere in the country. And prices are down 2.6% year over year, the fastest decline on this list. The reasons follow the familiar pattern, but in a more concentrated form. The steel industry that defined this city has contracted significantly. Population has been shrinking for years. The economic transition to new industries is ongoing and not complete. But here's the investor question worth sitting with. At 1,637 euros per square meter, how much further can prices realistically fall in absolute terms? The percentage declines can look dramatic, but the base is already very low. For buyers seeking affordable family homes, for long-hold investors comfortable with below-average liquidity, or for buyers planning personal use over a decade or more, Salzgitter presents a case that simply doesn't exist in Germany's stronger markets. The risks are real. Resale liquidity is limited. Rental demand is modest. Further demographic pressure is likely. But at these prices, the margin of safety is built in a way that Munich or Hamburg simply cannot offer. The question isn't whether Salzgitter is perfect. It isn't. The question is whether the price adequately compensates for the risk. And for a certain type of buyer, it might. So here's what the full picture tells us. Germany's real estate market in 2026 is not collapsing. These cities represent something more specific: the fracture lines inside a polarizing market. Strong cities rising, weak ones quietly sliding. And that gap is only going to widen. The cities that survive will be the ones that attract the young, the mobile, and the economically active. The ones that can't face a long, slow erosion. The same country that gives you 1,637 euro per square meter in Lower Saxony gives you 9,000 euros in Bavaria. These are not the same investment. Know what you're buying and why. The opportunity in 2026 is real, but so is the trap. If this shifted how you see the German market, subscribe. Next week, we're covering the cities where prices are rising fastest and which ones are dangerously overheated. Drop a comment below. Which city surprised you most? Stay curious.